Hello, everyone. Welcome to the Think BRICS YouTube channel. Today, we are honored to have Warren Mosler here. He is a distinguished economist, the founder of modern monetary theory, and a pioneering voice in contemporary fiscal thought. This marks the first of what we hope will be a series of interviews that delve deeper into his ideas and the implications of modern monetary theory, especially in relation to the evolving role of BRICS countries in the global economy. We are also very proud to support and corroborate the growing initiative advocating for Mr. Mosler's nomination for the Nobel Prize in Economics. Thank you for joining us today, Mr. Mosler.
Oh, thank you very much for that introduction. Good to be here.
Yeah, yeah, we're very happy for you to be here. So, I guess as the founder of modern monetary theory, for people who have not uh, don't know the full ins and outs, can we start with a very 30,000 foot view on what modern monetary theory is?
Yeah, so in the early 1990s, we had a major budget debate going on in the United States. It was a presidential election. Ross Perot's platform was balancing the budget, fiscal responsibility, all the types of things you still hear quite a bit of today. And I had the understanding from my experience on Wall Street as a primary dealer at Bankers Trust and being involved in monetary operations for a long time. I had the understanding that the funds to pay taxes, the funds to buy government securities come only from the government. And everyone inside the Federal Reserve monetary operations that I knew and spoke with knew this implicitly. They say it differently. They say we can't conduct a reserve drain without a prior reserve add, which means payments can't be made from the banking system to the government unless the government first gives the banking system the money. The money that goes to the government comes from the government, uh, or else it's counterfeit. If you have a $20 bill, it's signed by the Treasury Secretary. You can't make your own $20 bills. Now, everyone in Congress at the time, and they probably still do, believed that they had to get money either by taxing or borrowing. And what they didn't get from taxing, if they wanted to spend more than that, they had to somehow borrow it from the likes of China. And they talk about and leave that debt to the grandchildren. And that's the central discussion of the whole thing. Is it worth borrowing from China to spend more than we're taxing? The whole implication is they are looking for money to be able to spend. Uh, the correct understanding, which is understood by every central banker in monetary operations and has been since the beginning because it's their job, is that the government thinks first, and then some of that money is used to pay taxes, and the rest is not, and it's just saved as uh, in the first case, just balances in their cash accounts at the Federal Reserve. And then after the money's already been spent, some has been used to pay taxes, then Treasury securities are offered. So the rest of that money that's been spent but not yet used to pay taxes has a different place to go. And presumably, it's done at an auction to the highest bidder. So it pays a little more interest than just keeping money in the cash account. And it's what's called a reserve drain. It just shifts dollars that have already been spent from the reserve accounts, the cash accounts at the central bank, to treasury securities, which are savings accounts at the central bank. So the public debt is nothing more than all the dollars that have been spent by the government that haven't yet been used to pay taxes. It's a residual. It's the net money supply in the economy. It's the equity behind our entire credit structure. It's not a problem. And I recall President Reagan saying, if it ever gets to 90 billion, we're all doomed. And it just keeps going on and on like that with higher and higher numbers. And of course, nothing ever happens because it's not of any financial consequence. It has other consequences. The spending has consequences, but the deficit itself is of no financial consequence. And that's what started the whole thing. And then from there, uh, that first thought, that first understanding, it expanded. And this expansion didn't take very long. I was working, at my desk at my firm, and I had my research people with me. And very quickly, what we recognized was the currency itself is a simple case of a public monopoly. The government is a single supplier of the thing that's used to pay taxes, of the thing that's used to buy bonds. And therefore, as any monopolist, it's price setter. That means the source of the price level is necessarily prices paid by government. So I'm getting a little technical for you here. So let me stop for your next question.
Yeah, no, you actually make there are two really good points that I want to just kind of hone in on super quickly. I think the first is, like you said, modern monetary theory is the recognition that the government, the state itself, is the setter. They are the only ones, the monopoly that can issue money. And I, like you said, central bankers across the world already know this. Yet,
Yeah.
for some reason, it's not getting translated really in our fiscal and our monetary policies. And
Yeah. So
like,
it, mhm. Yeah, it answers another question. Once you start on this, it answers all kinds of questions. The fundamental question is what is money in all the textbooks? And they'll go on and on about it's a unit of
yeah,
account, medium of exchange, store value. But once you understand this, you recognize that it's a tax credit. When the government imposes a tax liability, okay, it specifies what you need to pay that tax. That's the tax credit. And in the case of the United States, it's the US dollar. So I can't answer the question of what is money. That's just an academic definition. But I can answer the question of what the US dollar is. That's the thing needed to pay US taxes. It's a US dollar. The US dollar is a tax credit for the US government tax liabilities. The yen is a tax credit for Japanese tax liabilities. The euro is a tax credit for the tax liabilities in all the euro nations. And so, and that's what I was telling you about. Once you have the first understanding that the funds to pay taxes come only from the government, all these other questions are just immediately answered and become crystal clear to anybody looking at it. And it becomes an excellent framework to analyze everything that goes on in any monetary system.
yeah, absolutely. And I think we can kind of see how that's translating right now in two different ways. I think in one way, when I talk to other people about taxes and money and so on, they always assume that the government is going to issue the tax to first before you would basically get the money and spend it or anything like that. When in fact,
Right?
it's actually the government, it's the flip. The
Yeah.
government's issuing the money so you can pay your taxes and for the state
Yeah.
to sustain itself. Um,
Yeah. Let me just add quickly. It's like, does anybody think the football stadium has to collect the tickets first before they can sell them? Of course not. They come from the stadium. They have to sell the ticket first before they can collect it. The government has to spend, credit your account before it can debit your account. It's that simple. And up until about 300 years ago, this was self evident to every human being on earth. It only became a mystery, as the financial systems got more complicated and the basic understanding got lost.
Yeah, I mean, you have President Donald Trump now is on him and Elon Musk are on a tirade to, destroy, not destroy, but to reduce the government deficit by really any means necessary, cutting Medicaid and cutting access to Social Security and things of that nature. So even though central banks across the world know this, apparently the president of the most powerful country right now doesn't know this.
Yeah, I've talked to them. I talked to senior officials in monetary operations at the Fed. I used to visit them a couple of times a year. And I'd say, well, who else understands this? Does anybody on the Federal Open Market Committee understand? There's 30 appointees there. They said, no, none of them do. And that's part of our problem when we try to explain monetary policy. They just don't understand it at the operational level.
Yeah, like we were talking before about like what the definition of money is. I think everyone kind of has this. Everyone is imagining money to be tied to gold. Everyone always has money tied to silver, anything like that. Like the fundamental assumptions of what money is and how monetary policy works is like completely lost on really any fiscal or monetary policymakers right now.
Yes. Yeah, absolutely.
So
I didn't know there was going to be a test.
Well, you're the
That's
you're the
okay.
guru. I have to show you.
Yeah, right.
So here is just a
Yeah,
time series plot about showing the percentage of government debt versus the percentage of private debt,
yeah,
and you can see here that by the 2000, the Great Financial Crisis, how low the government percentage of debt was compared to the private debt. You can
yeah,
even see similar. You can even see it in a similar way
yeah,
with the Great Recession as well. If
yeah. Well, there's an expression that's true, and it's loans create deposits. Okay,
Mhm.
so if anybody has a dollar in the bank, it's because somebody else and has more. Uh, they have unspent income. They have more. Uh, they earn more. They obtain more than they spent. They have dollars in the bank. It's only because somebody else did the opposite, and that's how it works. So that means somebody else spent more than they took in. And so
Mhm.
if you start with a room full of people and nobody has any dollars, nobody's ever going to have any dollars. If they get $100 from outside the room, the total in that room is going to be $100. It can be shift between individuals, but it's not going to go up or down. The only
Right.
way the total dollars in that room can go up is if they come in through the window from another room. Okay. And this is what sector analysis is all about. So we have the government as a sector, and then we have all of us, the non government, as another sector. And the only way the rest of us can have any kind of a net money supply, any dollars, saved, for lack of a better word here, is if somebody from a different sector, such as the government, spent more than they collected, spent more than their income. So the only way someone can spend less than their income and have that money left over is if somebody else spends more than their income. And it's called the paradox of thrift. It goes back 300 or 400 years in the analysis. This is not new stuff. And so and that deficit spending is what creates the accounts, the credit balances in everybody else's accounts. Now, there's another way to say it, and that is unless the uh, total deficit spending, public and private, okay, let's put it this way: the total deficit spending, public and private, is what equals the total savings. Okay, and so when if people want to save, money's going in a pension fund and it's not getting spent. It can't get there unless it's funded somehow. And it's funded by deficit spending from either
Exactly.
the private sector or the public sector. And so we can look at the combination of those two. That will tell us the total increase in what you could call the money supply, what I'd call the net money supply in the economy. Well, not the net, just the money supply in the economy, the actual balances created by deficit spending. And it's a policy decision as to whether they're going to come from private or public. There are a lot of different policies you can make to change that ratio that you just showed. And so those ratios are the outcomes of our policy decisions, which we call the institutional structure set up by Congress.
It's just so interesting to me that
Yeah,
you see in the Great Recession or the Great Financial Crisis and in the Great Depression, private debt to GDP is basically an all-time high.
yes, yeah,
Government deficit is basically at a very small point. So
yeah,
policymakers have
yeah.
access to this amount of data and more. So why are they not considering private debt
Well,
here?
what happens is we have what are called the automatic fiscal stabilizers, and what that means is during good times, the tax liabilities, tax what they call tax receipts, actually go up faster than even the government can spend money. So if you look at the growth periods, you'll see deficit spending going down because tax receipts are going up, and government spending is for like unemployment compensation, transfer payments, they call it, are going down. And so you'll see the deficit going down automatically from these automatic fiscal stabilizers, as they call them. And it gets to the point where the government has deficit has gotten too small, okay, to support the credit structure that's allowing that to happen. It's private sector credit expansion that's paying the taxes, as the tax structure, the aggressive automatic tax structure is collecting more and more money on the way up. And the let's call it the debt to equity ratio gets stretched. The private sector debt gets up. The public sector debt is actually the equity of the private sector until it collapses. And the private sector debt growing on its own is unsustainable unless there's sufficient public sector debt to fund it, to fund the equity behind it. And the whole debt structure is required, ironically, largely because of our tax advantage savings policies. So when you put your money into your pension fund, it's tax deductible. It comes out of your pre-tax income. So if you're putting $100 in, your choice is to put $100 into savings or to keep it as income and pay $30 in tax. So it becomes a pretty easy choice to put your extra money into savings and not spend it. And so we grow this pool of unspent income because it's all tax advantage by the trillions. We have 30 or 40 trillion of this unspent income that's piling up because of tax advantages, which creates a need for deficit spending, public and private, to fund this thing. Otherwise, you're going to get massive unemployment, which happens periodically when the deficit spending falls short. In which case it goes back up again fairly rapidly in a collapse because tax collections fall off and transfer payments go up. I call it the ugly way to get back to the levels of deficit spending you need to support these tax advantages for savings. So the same people, they're talking out of both sides of their mouth, who want lower deficits are also calling for more savings incentives. Not seeing it's the opposite side of the same coin. I don't know. Is that too complicated?
No, it's it
Yeah.
feels like you're telling someone what to do, and then they do
Yeah.
the exact opposite because
Yeah.
the entire structure is just so completely misunderstood. And
Yeah. Yeah.
when you're ringing citizens really by shifting the debt more towards them while you're not spending money to keep a growing population, you know sustained, and it's just gonna all fall over like a house of cards.
Yeah.
Like, so, but
Well,
I want.
yeah, you could say fundamentally we have a tax requirement in place which carries with it savings desires because the laws give you tax advantages for savings, and we're not spending enough to cover the need to pay taxes and the desires to save. And the evidence is the unemployment rate goes up and excess capacity goes up because of that. And so it's a very simple identity, really. There's no theory behind this. It's just an identity.
Yeah, and I wanted to get kind of wanted you to elaborate on your thoughts about the idea of unemployment and price instability in particular. Like, when we talk about like inflation, and when we talk about like higher unemployment, people immediately think, well, let's just inflation is getting too high, let's raise the interest rate, basically stop the economic machine from going until there's a not until activity declines, so inflation goes down, or vice versa. But you've said that because the state itself is at the heart of the monetary system, ideas like
Yeah.
unemployment and price instability are political choices. Can you elaborate on that a little bit more?
Yeah. You've got so much there to unpack, though. I hardly know where to start. So, look, we know. Let me go back to what MMT is by giving you have to have, we have a model, and I call it the MMT money story. And it's a very simple model. You have a government that wants to provision itself. It wants people to be in the military. It wants a legal system. It wants public health. It wants whatever government, public education, whatever government wants to do. And so, how do you get that done? What do you do? Where do you start? So, it starts with a government that wants to provision itself. The way we do it is the first thing we do is impose a tax liability. So, in that sense, taxes come first, but it's not tax payments, it's tax requirements that come first. And to keep it simple, so it can be understood, I'll say we put a tax on everybody's house, do a simple real estate tax. We could use an income tax, but it's complicated and variable and it extends the discussion. But so we'll just use a property tax to start here for our basic model, our empty money story. We put a property tax on everybody's house in something new called the US dollar that nobody has. It's George Washington just getting started. Now, this is not a historical example. I'm just using this figuratively. And, uh, and we say this tax is payable. You owe $1,000 per month in property tax. So we've just made a statement, $1,000. Now everybody knows what a dollar is. It's the thing you need to pay your property tax, or you're going to get your house burned down, or your house is going to get sold. You're going to lose it. Okay, so we start with a tax requirement. Now we have a population that overall needs those dollars to, to not lose their house. And so people need dollars. The only place you can get the dollars is the government. And and that's the situation we created with this tax liability. We created a population of unemployed people, people seeking paid work who can't yet find it because there's nobody offering dollars yet to pay them. Okay, so step two, the government then offers public service jobs to anybody who wants to come and work, paying in dollars. And now you will get people showing up so that the economy doesn't lose its houses, and people will show up to work to earn the dollars that they need to pay the tax. And those will be the soldiers and the public health workers and the teachers and the everything else the government wants, the legal system, the judges. So they show up for work. Then the government pays them, and then the taxes get paid. So that's this what we call the sequence. Number one is tax liabilities. And the first thing people say when they hear about modern monetary theory is, "Oh, yeah, that means you don't need any taxes." It's like the whole thing is based, the tax liability is fundamental. Nothing happens without that, and they think everything can happen without it. It's nothing happens without the liability. Now, the government doesn't start by getting the dollars any more than the football stadium starts by, getting tickets from people. It has to sell the tickets first before they can collect them. Okay, and you've got a population that doesn't need the tickets to not get their house, not lose their house, but they want to see the game. So it's a positive instead of a negative incentive, but it's the same thing. So we've got simple money story. Taxes, tax liability creates unemployment, people looking for paid work who were not unemployed before that tax liability hit. Government provisions itself by hiring them, and then they get paid, and then they pay their taxes. And that's the end of the chain. After that, the government has no more use for those dollars. It can throw them away. And in fact, it does if you pay your taxes with actual cash. Uh, if you're a waiter and you earned all these old $20 bills and you use them to pay your taxes, after you paid them, the government will send them out to be shredded. And you can go online to fact check me. You can buy the shredded money, bags of it online, right there. That's actually what they do. And it's the same. You buy a ticket to the Super Bowl, it's $5,000. You sell it to the next person for $10,000. He goes to the game, hands it in. The guy takes his ticket and tears it up. Why would he tear up a $10,000 ticket? Because it's the same reason the government tears up the money. It's used up after it's paid, when the money gets paid. But when you do it by computer, the government credits your account when you work. You then pay taxes, it debits your account. Okay. And when it debits your account, it doesn't have anything to spend. It's just a scorekeeping exercise. That's the end of it. Okay. Now they'll account for that and they'll put a credit in the Treasury's account. But look, there's this illusion that there's money flowing from account to account. It's the same illusion as when you watch this TV screen. You can watch a TV and you think there's football players running back and forth. But if you get right up close to that screen, all you have is dots going on and off. There's nobody moving on your TV screen. Likewise, with money today, it's not moving. There's just numbers getting changed up, getting changed down in accounts. Dots going on and off. That's all it is. It's scorekeeping. So back to your questions now about inflation. Now we have to look at where the value of that money is, and the answer first is that the value, when you have a monopoly, the value is what the monopolist tells you have to do to get it. If the government says you have to work, 8 hours to earn $8, that money is going to be worth $1 an hour of government time for government work. Because if you want to do something else, you have the alternative of working 8 hours for the government, and and at some level, if 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 prices don't aren't at a level where people where it's attractive to work for $8, people are going to be losing their houses. Okay, so that establishes a um, standard in the economy, a minimum standard actually, because the government in my base case is offering a job to anyone who wants one, and uh, and so nobody else can offer less than that because you can always go to work for the government. And if you want to hire people, you're going to have to pay more than that, or else they can go to work from the government, or it has to be more pleasant work. But at the end of the day, it's what you have to do to get that money. If the government, instead of paying, uh, $1 an hour for people's work, decided to pay $2 an hour, well, now the money's only worth half as much. Okay, you've just had 100% inflation. They've just cried down the value of their currency by 100%. But it's a policy decision. They don't have to do that. They know if they wait, people are going to come at whatever wage they say, because if they don't, they're going to get their houses burned down or they're going to get them sold, at auction. It's coercive. The whole tax system is coercive. Once you need the government's money and they've got it, they're price setter. They tell you what you have to do to get it, whether they know it or not. Now, our government doesn't know it. So when they see people, oh, we should give everybody a raise because the CPI, whatever that is, went up, and so we're paying more, they've redefined the value of the currency downward. So that was your first question that you snuck in there about inflation, but that led to three or four other things which I've forgotten right now. So if you want to remind me, I'll respond to those.
Well,
Oh
no,
yeah, well
it's
let's look at unemployment is created by the government in the first instance by design to provision itself. If we have residual unemployment, what does that mean? It means the government put a tax in place, which it alone, created all these people looking for paid work, and then didn't give it to them, and instead caused desperation where people are losing their houses. It's like, why would you do that? Why would you put a tax on someone's house because you're trying to provision yourself and then not give them a job? It's like that doesn't make any sense. It's like, I've called it a crime against humanity. Nobody would do that if they understood it. I don't think. Okay, you'd either lower the tax if you didn't want so many people showing up, or you'd hire the rest of the people that your tax caused to become unemployed. In my basic model, you put a tax in place, causes a certain number of people to show up for work, you hire them, they pay the tax. Why would you exclude anybody? And if there was a line of millions of people still looking for work, what else can they do except either pay your tax or save it? Those are the only two options. You've created both the need to pay taxes and the need to save. Nobody is saving your currency before it exists, before there's a tax. Okay, it's just not happening. Any savings desires in that currency come after the tax liabilities have been put in place. Okay, so it's unemployment's an absurdity. Okay, and it's only due to these people having the sequence backwards. They think they need to get money to be able to spend. And if they hire these people, they're going to run out of money or won't be able to borrow, or some backwards notion of how the thing is how the transactions work.
yeah, the people are not going to save a currency that has not been created. It's a very profound, it's a very profound thing right there, and
It
that's something
should be.
that
It should be, but
it,
it is.
it,
That's the sad part. It should not be
it
profound.
it's interesting though, because we talk about, because I think, you talk about unemployment and we talk about inflation and everything like that, which are very prominent things that you hear from the Federal Reserve. It's
Yeah,
what they use in their benchmark and their interest rates and whatnot. But I want to transition over to nations in BRICS and also nations in the
yeah,
global South too, because when we're talking
yeah,
about um, a country trying to sustain itself,
yeah.
how can they apply the idea of modern monetary theory in their own monetary and fiscal policies to ensure that there is no unemployment and prices are stable and people can find work that they find, I don't want to say decent, but they feel they are contributing to um, a more prosperous nation for everyone involved here.
Yeah, so they could start out by offering a public service job to anybody willing and able to work. And if you look at most of these countries that are classified as emerging markets, I think every one of them has that I've seen has very high levels of unemployment, particularly when they look at real unemployment or whatever they want to call it. 10%, 20%, 30%. When you look at any uh, what they call G20 country, it's always you know 3%, 2%, 3%, 4% levels of unemployment, never the higher levels. So your real wealth is equal to your real output that you get from people working. Okay, that's
Mhm.
your pile of stuff. Plus any imports you get gives you a bigger pile of stuff to consume. Minus any exports you have to send out, which makes your pile of stuff lower. Now, of course, there are always strategic considerations, and people look at that and they say, "Oh, well, therefore you should just import everything and be vulnerable to the whole world." I'm not saying that. I'm just talking about your real wealth right now, not what you should be doing down to your last, your last dollar of policy decision. But your real wealth is your domestic plus imports minus exports. That's an accounting identity. Okay, and so if you look at these countries, or the United States, or any advanced country, uh, your domestic output is the largest part of your real wealth. Okay, and unemployment takes away from that. The more people you have working, the more domestic output you have. So the low hanging fruit for most of these countries to have a dramatic increase in their real standard of living. And I'm not saying that's increase in real standard of living is going to be all these imported, trinkets and luxuries and that type of thing, but their real standard of living can be 20, 30, 40% higher by putting everybody to work, whether that's in public infrastructure, public education, transportation, and things that don't necessarily require a lot of capital goods. Now, if you can get the capital goods, the same number of people can produce more output. That's productivity. That's also a big channel for increasing output. But productivity gains are 1 to 2% a year, maybe 5 or 6 if you're at a very low level. We're looking at 20, 30% gains just by going to full employment policy. And you can always do that with your local currency. There's no obstruction other than if you have an IMF loan, their terms and conditions might prohibit it, but that's different. Okay. But, that type of thing aside, those kinds of self imposed constraints, there are no constraints on sustaining full employment, sustaining your real wealth. And the more things you produce domestically, the more potential things you have for exports that would be attractive to the rest of the world, and therefore, you can um, enhance your mix of output. Right, some of it gets sold abroad in exchange for other things that you need more than what you sold, and so again, it comes down to more domestic output always increases your real wealth. Okay, and so for any, I'm addressing a couple of different points that you asked about. So number one, yes, any country with its own currency can sustain domestic full employment. To give you the short answer to what you asked.
Yeah, I think for like we're talking about nations like in BRICS, for example, or ones that are emerging countries like the like you said, if you're going to have the low hanging fruit, you have to talk about public infrastructure and
Yeah,
developing that public infrastructure to integrate all the sectors in your economies that much more.
yeah,
Building transportation networks, diversifying your source of energy for your production, because it is
right.
that domestic. It's the domestic demand that will
Yeah,
contribute to that output. Indonesia
yeah,
grew a little like 5%, and you could see the work of the various, the previous president's like infrastructure initiative. You can really see that start to play out on their economic output right now. But I do
yeah.
want to ask you
Let,
just one more
yeah,
question
yeah. Let me
about,
just add, if I could
yeah,
quickly, the
yeah,
biggest obstacle that I see to this is the export-led growth mercantilist narrative, where the exporters are in control and they
hmm
sell outside of your country. So what they want is the lowest possible costs. They like people in desperate situations. They like high unemployment because it keeps their costs down. And exporters, they have no interest in domestic well-being, so to speak, as long as people are kept alive, get enough calories a day to live, and can work for them for the least compensation. And they're not like wrong for doing that. That's just the nature of their job. But it should be the nature of government, the nature of the nation to understand that they should not have a seat at the table when it comes to domestic policy because they have a whole different interest in mind. Go ahead.
Yeah, no, there's a very you can really see that idea of we want the lowest cost possible, and you can really see that fleshed out with the deindustrialization, the United States, and the everything that other nations are trying to do to basically subvert the development of other emerging nations to keep the costs down as best as they can for their own benefit.
Yeah.
But one more question I want to ask you actually relates to BRICS as an institution itself.
Yes.
We see a lot of talks about de-dollarization
Yeah.
and what the alternative it will be, and there's still not a clear cut answer. But one idea that's been held out there is the BRICS dollar, where the BRICS as an institution creates a currency that it uses kind of like in the Keynes's proposed Bancor model to settle, balance, deficits and surpluses between countries. My question to you is can BRICS, as an institution, not as a nation, where it doesn't have any citizens that can sustain itself, can it make a currency like this?
Uh, Sort of. It would have to either have a tax liability or some basket of currencies. But what they want, the way when I read between the lines, is a payment system. They didn't like
Mm-hmm.
it when they got cut out of the U.S. payment system, and so they could use a different currency. They could use Euro Clear, or they could use whatever Russia uses domestically. They could all have accounts in Russian banks and a Russian bank or at the Russian central bank and clear in rubles with each other. And then once they got those, if they didn't want that currency, they would know the exchange rate in advance and sell it for another currency. The problems being that there were sanctions and everything else by the United States against using Russian rubles to clear trades and that type of thing. Um, so what they've been trying to do is glom onto some kind of a payment system that's independent of the United States and independent even of other countries, because a payment system in the hands of another country, you're kind of like out of the frying pan into the fire, potentially.
Yep.
You get in the same thing. And they I don't think they've like identified that they're just trying to create a new payment system. And so to do that, they want a common currency that they could clear, not recognizing that these currencies are tax credits. And uh, could something be designed for that? Uh, yes. Okay. But the way they're doing it is to come up with a fixed exchange rate system, whether it's gold standard or currency basket or something like this, that looks to me like it's going to have the traditional problems of all fixed exchange rate systems. And it's to the point where they're probably not going to do it.
Mm-hmm.
And so what's happening is we're seeing other payment systems in dollars emerging, like Tether, right?
Mm-hmm.
It's a you can buy these things with dollars. You can buy them with other currencies, denominated in other currencies, and then you trade. That token can be exchanged to somebody else who can then um, uh, get back a fixed amount of the underlying currency. Let's say it's a dollar, it's fixed 1 to 1. Or if they want to switch to another currency, it would be at the exchange rate at the time. So it's not going to be stable in every exchange rate. It can only be stable in one.
Mm-hmm.
But it's no worse than just trading in dollars. But without the U.S. restrictions, without the time delays, without the taxation, without the regulatory requirements of dollars. So it's a way to have a clearing system that's outside of the U.S. Um, purview, and so that something like that, becomes popular, and it's always a response to problems with legal problems with the current system, legal restrictions that are put in place. I remember where did euro dollars come from? Well, when Citibank dollars or JPM, they pay you interest on those dollars, or if you loan them money, they pay you interest. And the Federal Reserve was charging fees for deposit insurance, a few basis points. So they set up a company outside of the U.S. where you could put money on deposit, get a little more interest because they didn't have to pay fees,
Okay.
but you didn't get the insurance either. It's the same thing where you have, blood flows around the clock when the government puts pots in there to try and tax and regulate it. You'll see the systems get set up around it. Most of the clearing in the U.S. is cleared through private clearing, like chips, and not through the Federal
Right.
Reserve. It's only
Yep.
net through the Federal because they do it cheaper. And the Fed wants them to do it cheaper because they don't want to clear all those transactions for 4,000 commercial banks. They don't want to gear up to do that. They'd rather have private industry do it. So it's the same thing here, where I think BRICS is heading toward maybe still the dollar as a numeraire, but some kind of a token like Tether to be used for clearing so that they can use dollars without the US being involved and without having to own dollars, without having to have dollar reserves, without any of that. You don't need any of that if you simply use these tokens.
Right, and I think just a quick thought is basically the United States, the European Union, using basically weaponizing the dollar, weaponizing the SWIFT payment system, weaponizing
Yeah,
Euroclear. All
yeah,
it's all of it is doing is incentivizing the not just BRICS nations but other nations that they want an alternative where they don't need to have as much investment in the dollar because they don't trust the dollar nor the leaders
right,
that are advising on these policies and saying,
right.
sanction Russia, so on and so forth. And that's what BRICS is gonna,
Yeah,
is aiming to provide something that is
yeah,
completely impartial and something that works for everyone. But
yeah. And when they do that, there are no negative consequences for the United States.
yes, yeah,
It
that's another
it
thing.
just doesn't. Yeah, it just doesn't matter. So they set it up as a restriction to try and get some political leverage over whatever,
Yep.
Russia's war or something. And then if it doesn't work, it doesn't work. They can go on to something else. The U.S. has nothing to lose by doing that. And so they do it.
Yeah, and we should definitely talk about what the if how and if the United States has anything to lose as these payment systems develop. But for today's program, Mr. Mosler, I
Okay,
want to really sincerely thank you for joining us and sharing
sure.
your enlightening perspectives in this discussion today. And I'm hoping that this conversation is going to just be the beginning of a deeper exploration more into your work and the incredible transformative potential that modern monetary theory can have on emerging economies and countries across the world. We look forward to continuing this dialogue here and supporting the recognition of your contributions, especially the ongoing efforts towards your Nobel Prize nomination. Again, I really want to sincerely thank you for joining us today. This was an amazing discussion to have.
Uh, Thank you very much. Very much enjoyed it. You
Yeah,
guys keep me
yes.
sharp, and the more the better.